Hai, Assalamualaikum. My name is Nur Fatin Hidayah binti Samsi. First of all, I will introduce what is depreciation. Depreciation is the process of allocating the cost of its asset over its estimated useful life. A non-cash expense whereby it is just recognition of the expense as the asset is used over time. Now, I will give a few examples of depreciated of tangible assets such as buildings, plants and machinery, and the example of not depreciated of tangible assets such as land. Next, let's see the difference between depreciation and depletion. What we must know, depreciation deals with tangible assets, while depletion was attempts to measure the wearing away of natural resources such as mineral deposits and timberlands. Other than that, I will share the difference between depreciation and accumulated depreciation. Let's focus to depreciation first. The expense is calculated for each period, while for accumulated depreciation refer the total depreciation expense from the first year until the present according year. The second one, it is considered as an operating expense in the income statement for depreciation, and it is found in a balance sheet for accumulated depreciation. Let's move on to methods of depreciating a fixed asset. We have three methods to calculate depreciation. The first one is straight line method. This method used to allocate depreciation equally over the estimated life of asset. Straight line method can be calculated by going through cost minus salvage value divided useful life. We can get the cost of the price plus other costs. Example of other costs such as installation and transportation costs. The second one is double declining balance method. This method is an accelerated depreciation method in which a significant amount of depreciation is given in the early years of the asset's life and lesser amounts in subsequent years. The method already stated here. First formula to calculate depreciation rate by calculate 1 divide useful life times 2, and second formula to calculate annual depreciation by calculate 1 divide useful life times 2 times beginning value. And the last one is sum of the year digit method. It's produce more depreciation expenses in the early years of the asset use. This method also have two formula. The first formula to find sum of digit by calculate useful life times useful life plus 1 divide 2. The second formula to find annual depreciation by calculate remaining useful life times cost minus salvage value divide sum of digit.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Alia Farisha binti Rashid. Now I will explain about taxation. Taxation is a payment or levy based on a business earning or asset disposal. Because it generates tax liabilities, the sale or disposal of assets has a direct influence on the firm's cash flows from sales. Next, I will explain about the computation of taxation. There are 8 steps to compute the total tax liability. Step 1. Find accumulated depreciation for how many years the asset has been used. Okay, how to find accumulated depreciation is we have to using SLM. The formula of SLM is cost minus salvage value divided by useful life times used years. Okay, for step 2, we have to find a book value. The formula of book value is initial cost minus accumulated depreciation. Okay, step 3, find a capital gain or loss. How to find it? We have to use a formula of selling price minus initial cost. If capital gains, we need to calculate the capital gain tax. If capital loss, we no need to calculate the capital gain tax. For the step 4, we have to find profit or loss. We have to use formula of selling price minus by book value. If we get profit, we have to calculate tax on RAD. If loss, then calculate tax saving. Step 5, compute tax on R&D. Tax on capital gain and tax on EBT. How to get tax on RAD? We have to find profit or accumulated depreciation times corporate tax rate. How to know if we have to use profit or accumulated depreciation is we have to find the lowest amount between them, between the profit or accumulated depreciation. For tax on capital gain, we have to use formula of capital gain times capital gain tax rate. Then for tax on EBT, earning before tax, times corporate tax rate. Okay, for the final step, we have to find total tax liability. Tax on R&D plus tax on capital gain plus tax on EBT, and we will get total tax liability.
Hi, my name is Nisa Adlina. So today I will explain about straight line method. Under this method, depreciation is allocated equally over the estimate life of the asset. The formula we use is cost minus salvage value divide useful life. Cost equal price plus other costs such as transportation and installation costs. Exclude training costs and exclude costs below Rm500 ringgit. The example question is, a machine was bought 3 years ago at a price of 138,000 ringgit. The installation cost was 2,000 ringgit. The machine has 2 years remaining life. The expected salvage value of this machine is Rm10,000 ringgit. Compute the annual depreciation expense using straight line method. So first of all, we should extract all the information given. First, cost equal price plus any cost such as installation and transportation costs. Exclude training costs if any. So Rm138,000 ringgit plus Rm2,000 ringgit equal Rm140,000 ringgit is a cost. Second, salvage value equal Rm10,000 ringgit. If not given, then assume salvage value equal Rm0. Then useful life equal 2 years. Remaining life of machine plus 3 years of machine being used. So equal 5 years. Next, after we done list all the information given, we start to calculate the annual depreciation. Annual depreciation equal Rm140,000 ringgit minus Rm10,000 ringgit divide 5. So equals Rm26,000 ringgit. Or you can construct a depreciation table such as at this example. If you want to use a table, divide 5 columns for year, beginning value, annual depreciation, accumulated depreciation, and book value. Then you just put the value in the box each column. Now we look at the example for year 1 for the beginning value. You just take the value of cost, which is 140,000 ringgit. And then the annual depreciation is 26,000 ringgit. And accumulated depreciation is the value of annual depreciation. So you just take the value and put in the accumulated depreciation. For the book value, the formula is the value of beginning value at the first, you need to minus with annual depreciation value. So you will get 115,000 ringgit. For the second years, it's just same step, but the difference at accumulated depreciation value. For accumulated depreciation value in the year 2, you must take the value of accumulated depreciation at the first, which is 26,000 ringgit. You need to plus with the value of annual depreciation in the second years, which is 26,000 ringgit. So you will get 52,000 ringgit for the value of accumulated depreciation in year 2. So you just follow the same step to get a value of next year. Next, I will explain about double declining balance method, or we call DDBM. DDBM is the accelerated depreciation method, which means relatively a large amount of depreciation is allocated in the early years of the life of the assets and smaller amounts in later years. Formula for depreciation rate is 1 divide useful life multiply 2. Meanwhile, formula for annual depreciation is 1 divide useful life multiply 2 and multiply beginning book value. Using the same example and steps in straight line method, construct a depreciation table for double declining balance method. Now we look at the example. For year 1, the value of beginning book value is 140,000 ringgit and the depreciation rate is 0.4%. So, if we want to get a value of annual depreciation, we need to multiply a value of beginning book value and depreciation rate. So, we get here 56,000 ringgit. For accumulated depreciation, you just take the value of annual depreciation, which is 56,000 ringgit. And the formula for end book value, the value of cost minus the value of account depreciation, which is the cost is 140,000 ringgit minus RM 56,000 ringgit. So the value is RM 84,000 ringgit. So you just follow the step for the next year. For the second year, the value of account depreciation, you need to take the value of account depreciation in year 1, which is 56,000 ringgit, plus the value of annual depreciation in years 2, which is RM 56,000 ringgit plus RM 33,600 ringgit equal RM 89,600 ringgit. Then you just follow the same step to get a net value of the years. Next, I will explain about sum of the years digit method, or we call SYDM. It produces more depreciation expense in the early years of the assets used. The formula of sum of digit SOD is useful life multiply useful life plus 1 divide 2. For annual depreciation, formula is remaining useful life divide SOD multiply cost minus salvage value. Then, using the same example and steps in straight line method, and construct a depreciation table for SYDM method. For SYDM table method, you need to do a 6-row table for year, cost minus salvage value, remaining useful life divide SOD, annual depreciation, accumulated depreciation, and book value. So we look at year 1. The first thing is we need to find the value of cost minus salvage value. So we get 130,000 ringgit. Then next step is remaining useful life divide SOD. So we get 5 divide 15. Next, to get a value of annual depreciation, the value of cost minus salvage value, you need to multiply with the value of remaining useful life divide SOD. So you will get the answer is 43,333. For accumulated depreciation, you just take the value from annual depreciation. For the book value, the formula is you need to take the value of cost and minus with accumulated depreciation value. And then you will get 66,667 ringgit. Then you just follow the same step to get a value of the next year.
Hi, my name is Aishatu Sofia binti Zuraimi, and on this part, I'm going to explain how does taxation works. So here we have an example of question. Fatih Sendian Berhad is considering of selling its 3-year-old machine that was purchased at a price of 500,000 ringgit. The machine is depreciated using straight line methods for 8 years useful life and salvage value of 20,000 ringgit. The company's earning before tax is 1.5 million ringgit. the tax rate on ordinary income and the capital gain tax are 30% and 25% respectively. So calculate the total tax liability if the selling price is 800,000 ringgit, 450,000 ringgit, 320,000 ringgit, and 150,000 ringgit. So let's go. So now, here we are at the taxation part. So this calculation might look a bit tricky, but I believe it is much easier when you understand it. On this calculation, you have to calculate on 4 parts, which is the first, book value, capital gains, tax liability, and lastly, the total tax of liability. So first, we have all the selling price. We have 4 different prices: 800,000, 450,000, 320,000, and 150,000. So I'm going to show you how the selling price of 800,000 ringgit. So the first thing first, you have to find the book value. So in order to find the book value, you have to minus the initial cost and the accumulated depreciation for 3 years. Why 3 years? Because the company has been used the old machine for 3 years, so we have to calculate the used years. All right, so the initial cost, it was given in the question, it is 500,000 ringgit. All right, and then on the accumulated depreciation, you have to calculate for 3 years. So how? So the initial cost minus salvage value divided by 8 years of useful life, and then multiply it again for 3 years. All right, so the answer would be 180,000. So the book value is 500,000 minus 180,000, so the final book value is 320,000. All right, so next part is capital gain. The capital gain, you have to minus selling price and the initial cost. So the selling price is 800,000 ringgit, and the initial cost stated in the question, it was 500,000 ringgit. So the capital gain is 300,000 ringgit. The next part is profit. In order to calculate profit, you have to minus the selling price and the book value. So the selling price is 800,000 ringgit, and the book value, the one that we calculated at the first, it was 320,000 ringgit. So 800,000 ringgit minus 320,000 ringgit, and the answer would be 480,000 ringgit. And lastly, on the tax liability, you have to calculate on 3 things. The first is RAD, or recaptured accumulated depreciation, and then you have to calculate the capital gain tax, and lastly, the tax on earning. So first, on RAD, you actually have to choose the lowest value between the accumulated depreciation and profit. Alright, so on the selling price of 800,000 ringgit, the accumulated depreciation is 180,000. Meanwhile, the profit is 480,000. So which one should we choose? Yes, exactly. We have to choose on the accumulated depreciation with the value of 180,000 ringgit. So 180,000 ringgit multiple with the company tax rate. It was also given in the question, the company tax rate is 30%. So 180,000 ringgit multiple with the 30%, you will get the tax liability, which is 54,000 ringgit. Why tax liability? Because the company gain a positive value, 54,000 ringgit. So that's mean the company have to pay on the tax. All right. So the second part is capital gain tax. So the capital gain tax, in order to calculate it, you have to refer back on the capital gain part, which is the second part. So the capital gain is 300,000 ringgit, sorry. All right, and then you have to multiple with the capital gain tax also given in the question, which is 25%. So 300,000 ringgit, and then multiple with the 25%, and the capital gain tax is 75,000%. And lastly, on the taxable income, all right, this part, it was given in the question where it stated that the company earning before tax is 1.5 million ringgit. All right, and here on the calculation, we have to multiple the taxable income before the tax and the company tax rate, 30%. So 1.5 million ringgit multiple with 30%, and the tax on earning are 450,000 ringgit. And then the total tax liability, you have to sum up on three things, which is the tax liability, the capital gain tax, and also tax earning. So 54,000 ringgit plus 75,000 ringgit plus 450,000 ringgit, and the total tax liability is 579,000 ringgit. And I'm going to show you another example of selling price, which is 320,000 ringgit, because this on this calculation there's might be a little bit of different. All right, so same thing, you have to calculate four things, which is book value, capital gain, profit, and also tax liability. So the first book value, it will be the same as the other selling price, and the answer of book value is 320,000 ringgit. And then the capital gain, you have to minus the selling price with the initial cost. So the selling price is 320,000 ringgit and the initial cost is 500,000 ringgit. So now you might notice there is a difference, because the initial cost is higher than the another selling price. So the answer will be in the bracket, which considered as negative 180,000 ringgit. All right, and next part is profit. So selling price minus with the book value, the selling price is 320,000 ringgit and book value is also 320,000 ringgit. So the answer is 0. All right, and last part is tax liability. So this is where they have a bit of different from the others of selling price. All right, so on the tax liability, on calculating the RAD, like I mentioned before, you have to choose the lowest value between the accumulated depreciation and also profit. So here, the accumulated depreciation is 180,000, while the profit is 0. So if 0, you don't have to calculate anything, because the answer will still be the same, which is 0, right? All right, so the company don't have to pay any tax. They don't have the liability on tax, and also they don't have the saving on tax. All right, so the next part is capital gain. So look at the capital gain part. The company, on the selling price of 320,000 ringgit, they gain 0. All right, they gain 0. That means they don't have the capital gain. All right, they don't have the profit, so you don't have to calculate on that. And last part is taxable income, or earning before tax, and this part you have to calculate same as the other selling price, which is 1.5 million ringgit multiple with the 30%, and you will get the answer of 450,000 ringgit. So the total tax of liability, you have to sum up all the three things, but we don't have on RAD, we don't have the capital gain tax, and we only have on the taxable income. So the total tax of liability is 450,000 ringgit. And we're done. We're done on explaining how does depreciation and also taxation works on financial analysis. So in this time, I would like to show the highest gratitude to our lovely lecturer, Dr. Maimuna Johari, or also known as Dr. Moon. She's been doing a very great job in teaching us in financial analysis, and she's very patient with our classmate, and I really love that. Thank you so much for teaching us. And I also would like to thanks to our group mate for giving a fully cooperation and also participating in this task given by our lecturer. Thank you so much. So I hope we can see each other on the physical class on this upcoming October. So thank you very much and see you soon.